let's talk about infrastructure now. Results for the first round of bidding for the much-awaited toll operate transfer projects, or the TOT projects, have been announced, and the real winner seems to be the National Highways Authority of India, the NHAI. The winning bid from Macquarie translates to almost 3 times the equity value estimated by NHAI. To talk more about this, Ajay Jain, Managing Partner at Indusbridge Capital Advisors, now joins us on this conversation. He's written a very interesting piece on BloombergQuint.com talking about how NHAI has emerged the winner. Ajay, many thanks indeed for joining us. You talk about the fact that this has been higher than what NHAI had anticipated.
Right.
Yet you point out to the fact that the second bidder has been much lower.
Yeah.
Is there a concern and is there a risk here?
Oh, well, first of all, I must congratulate NHAI on what it's done. This was long overdue. Number of kilometers of up and running assets. Perfect asset class for a pension fund or a sovereign to come in and, partake of the opportunity. But coming to your specific question, in this case, it's about 650 kilometers, for which NHAI itself had set a price expectation of around 6,000 crores, 6,258 crores to be precise. The winner has quoted something like
9,681 crore.
That's correct.
And the second bidder you point out is 7,500 crore. There's a 2,000 crore differential.
That's right. So, I don't want to get into the details as to, what assumptions Macquarie has taken in terms of their traffic expectation from these roads. And these are up and running assets, like I said, and beauty lies in the eyes of the beholder. One is traffic assumptions, which is the top line, which is where the revenues come in. Second, no-brainer is the cost of capital, how you discount it. Now, again, there also NHAI has very clearly articulated that's cost of capital, which is cost of debt and a 70-30 debt equity. And they have kind of indicated in their RFPs cost of equity, let's say 14%. Now, if the roads are up and running, typically these are yield assets. Like even if if you look at transmission assets, they're yield assets for the long term, like 30 years. In this case, this happens to be the case. And there, the cost of equity expectation is around 14%, as articulated in the RFP documents. Now, it's up to each bidder what kind of cost of capital it assumes. So either I think they have been very smart in perhaps procuring a very low cost debt.
Sure.
Because if you just do the math, right?
The bid seems aggressive is the point.
It looks fairly aggressive.
Okay, so one second question then. We've been through this before, where the infrastructure 1.0 story was when many people came in and started aggressively bidding.
Right.
So what were the lessons learned from there, number one? And number two, do you think this model have we finally cracked a model that's working for all stakeholders?
Well, to answer the last question first, answer is hell yes. This is something we've been waiting for. The infrastructure investors around the world have been waiting for that. Look, we don't understand the construction risk. We don't want to understand the construction risk. It's for the developer to develop the assets. Compared to the first round, which is happened in the, let's say, 10 years back, wherein the number of again such opportunities, public-private partnership, wherein bids were invited, wherein the developer or the bidder or the concessionaire had to actually undertake the construction. It was a 2-lane highway to be constructed to 4 lanes. If it's a 4-lane, to be 6-lane. Therein, the complexity was much more, as in you had to make a lot of assumptions around the cost of construction. Again, NHAI gave you some benchmarks that, look, this will cost so much. But again, everybody, went back to the drawing board and looked at the numbers. And it was again very aggressive.
Okay.
It was very aggressive in the sense that these people, could not undertake what they promised.
Sure.
This round, it's very different. This round, it's like
there is no construction risk.
There is no construction risk. This is pure operating risk, as we call it in the in the investment lingo. And there, all that one has to really look at is, look how my traffic is going to look like. What are the operational efficiencies I can gain? Can I run this for 30 years? Then there are, maintenance issues. Every day you see in Bombay potholes. But an NHAI road is very, very strict in its concession requirements, which is that you can't have an XYZ size of a hole in the road. So those requirements are there, which is, again goes back to your operations and maintenance capabilities, which if you don't have, you can always borrow, or you can employ someone, like in the case of any financial investor.
So as far as from what you're saying, I understand that this is a step in the right direction, that they've got most of the variables right.
Absolutely.
Specifically with respect to bank lending, again, in the earlier case, banks are now shy of touching infrastructure projects due to a variety of reasons of what's going on in the broader banking environment. Is bank lending is it coming through at all, or people are seeking other sources of funding?
So look, that depends on what the bank lending is for. So if it's construction risk, again, but before I even get there, there's a huge correction that's underway as far as banking sector in this country is concerned, or infrastructure sector for that matter, around all that we're talking about, dirty dozens, and now many dirty dozens. So number of corrections happening, which is what we call the twin balance sheet issue. Having said that, this particular asset class, which is essentially taking cash flow risk, should be the easiest for the banking sector to look at. Now the question is, do they have the ability to, given what all they're going through, to actually cut the check, because there's a lot of, like I said, correction underway, and moreover, can they perhaps meet this very low cost of capital, which I said?
Sure.
Can they lend at 6%? Because effectively, if you just look backwards, this amounts to raising debt around 6 or 7%.
Okay.
Is that available for 30 years in the banking sector in India? Answer is
maybe not. Maybe.
Answer is no.
Okay.
Because
so, I have one final question, and this is with respect to confidence. One thing that was completely absent in the infrastructure space, both for investors who are investing in these projects and for the stock market, complete lack of confidence in the sector. Are you seeing signs of that coming back? And is investment infrastructure becoming a viable business?
Look, green shoots, right? And until and unless the correction of the balance sheets happen, the private investment will be, stopping short of actually execute. They want to execute it, but they need that balance sheet strength to come through. Therefore, like I said earlier in one of the articles I wrote, through this process, the government can actually claim huge victory, which it has in my view. And I think you will see perhaps more of it once you've tasted success here in the power sector as well, power transmission sector in particular. Similar to NHAI, Power Grid Corporation has a number of assets which they can again monetize. But to kickstart this whole sentiment, to answer your question, this is perhaps the best way, wherein you sell the government assets, where government has no business of running these, and then monetize these, take the construction risk, which again can be with the government through the NHAI. But they also have evolved some really good models, like the hybrid annuity model, wherein the construction risk is actually shared between the developer and the NHAI. So all in all, very good story for infrastructure to get kicked off once again.